want to learn how to manage your own investments? Are you ready to stop paying investment management fees and start building wealth? The DIY Investing Podcast is dedicated to providing you with the knowledge, skills, and resources you need to be a better investor. Learn how to make investments through the use of fundamental analysis, mental models, and business management insights. Now, here's your host, value investing expert, Trey Henninger.
Hello and welcome to the DIY Investing Podcast. My name is Trey Henninger and I'm your host. Be sure to subscribe to the podcast to get more great investing content. If you're listening on YouTube, hit the like button on this video, and any other platform, your 5-star rating and review are a great way to support the show. Thank you for your support. So let's dive on into today's topic, which is discount rates. I've talked about discount rates before, how I use a 10% discount rate in my investing process. I use that to analyze stocks. I use that to evaluate my opportunity costs, and that's the discount rate I currently use of 10%. However, I think this is a very important topic because what you will notice is that many different investors use different discount rates. There's many different discount rates that you could choose as an investor. And what I want to talk about today is how discount rates have changed over time from the past to the present, and also how you can expect discount rates in the aggregate to change going from the present to the future. And kind of what I hope you get out of this podcast is to understand some of the historical basis for the discount rates that we choose, and also to really help you get a grasp on what it means to choose a discount rate, what it means to select a discount rate in your investing process. In some ways, this podcast is going to be a little bit more philosophical, a little bit more high level, because I think that's important for you to understand this critical component to valuations. Your discount rate is probably the easiest term you can change in a discounted cash flow model or any other valuation model that will drastically affect the intrinsic value that you place on a company. If you increase your discount rate, you're going to lower the intrinsic value of a company. And if you decrease your discount rate, you're going to massively increase the calculated intrinsic value of a company. So the selection of your discount rate is critical. So what we need to answer today is, why is 10% the discount rate that I use? Is 10% a discount rate that I would have used years ago? And is 10% a discount rate that I will always use in the future? And I think these are very critical questions. So in order to get context around discount rates, we're going to talk about discount rates in terms of the past, the present, and the future. We're going to begin in the past, and we're going to progress up to the present and proceed into the future. So I'm going to begin further back than you're probably expecting. And I think this is a good way of framing the discussion. So we're going to start in the past. So what do I mean by the past? Now, if you think about discount rates, if you think about some of the discussions we've had, many times you'll talk about, how has the S&P 500 in the United States performed over the last 50 years or the last 100 years? What have stocks performed in the U.S.? That could be the Dow Jones Industrial Average. That could be the S&P 500. It could be a broad spectrum of stocks. But what is the performance been in the past 50 to 100 years? Well, we're going to go much further in the past. What I want to talk about is 10,000 years ago. Well, we're going to progress back up to the present, but let's start thinking about 10,000 years ago. So what was it like 10,000 years ago? Well, if you think about investing in terms of 10,000 years ago, there's going to be a lot of problems that are going to present themselves very, very quickly. You see, what we do as investors is we put up money today in the hope of getting more money back in the future. Well, when you think about 10,000 years, you start to think, it's like, well, okay, investments really weren't made to a large degree. What was made as an investment? Basically, you're talking about the very beginning of agriculture. You're talking about the invention of agriculture, the start of the only investing people were doing would be putting seeds in the ground and trying to grow crops. So you were investing time into growing crops, but the return expectation was very short term. You're basically investing on a seasonal basis. You invested time and physical effort, and you took seed and used it to try and grow crops later in the season. And it was very unpredictable. You couldn't predict what the rains would be. It was very possible to get a big harvest or a small harvest or no harvest. All sorts of calamities could go awry. So if you wanted to invest during that time, it was going to be very, very difficult. And this is because there's no such thing as long-term investing in the agricultural world that we're talking about. The reason is because you couldn't predict the future. You couldn't rely on the future. For instance, think about 10-year bonds. Today, 10-year bonds are a staple of the financial industry. You have government 10-year bonds. You have corporate 10-year bonds. All around the world, different groups issue 10-year bonds. Well, what that means is that in order to lend your money to any institution, whether a government or a corporation, for 10 years, you have to have some sort of strong expectation of a few things. First and foremost, you have to trust that you will be alive in 10 years and that you'll be able to receive a return on that money. Now, that might seem kind of counterintuitive, but this is a critical piece going into discount rates. The implicit assumption, if you're putting out any investment, whether it's debt or equity, is that you're going to be around in the future to take advantage of any gains that you would find. Otherwise, you have no incentive to invest for the future. So you need a long-term perspective in order to make long-term investments. Well, when this began, this was incredibly difficult. In the beginning of agriculture, it was almost impossible to have a perspective that extended beyond a year. Your focus was season by season. You had to focus on investing in your crops. So you could raise crops, you could raise cattle, whatever it may be. And you had to invest time into that. You had to invest energy into that. And all of your work was dedicated to getting from one season to the next, to preparing for winter, storing up food for winter, getting through winter. And then when winter was over, you started on the next year. If you were an investor 10,000 years ago, they didn't really exist, but why did they not exist? Well, they didn't exist because think about what would take place. You would have to have excess food that you would be willing to lend to somebody, but you'd have to be only willing to lend it on an extremely short-term basis because you can't predict very far into the future. You don't know what harvests are going to be like. You don't know how much food there's going to be available next year or next month or next season. So maybe you're willing to lend someone some excess food for a month with the idea that you might get it back in a month. But the problem is that that's not how their system works because the seasons meant there were certain times when food would come around. So if someone didn't have food today, they were highly unlikely to have food a month from now. So you could exchange some services and that sort of thing. But it became very difficult because what you could not do was you could not make an investment in someone today in the hope of getting a payoff a year or two from now. Because there was no guarantee, one, that you would survive to that time or that they would survive to that time. Death rates were incredibly high. You had pestilence, disease, all sorts of calamities that could strike that could wipe out your investment. So the discount rates that would need to be in place would be huge. You'd be talking about loans that would exceed 100% per year in returns. So your discount rate would have to exceed 100% returns in order to justify taking the risk of not getting your money back. So let's move on from 10,000 years because I don't want to spend a lot of time there, but let's go to a lot more recently. And let's say 500 years ago. So 500 years ago would be somewhere in the 1500s. And here we have a different situation. So now agriculture is well developed. You have money systems. Monetary systems exist. Basically, gold and silver are used widely throughout the world. But what you have now you have a merchant class. It's a relatively small merchant class, but you still have problems. First and foremost, unlike today, where basically the merchants control the world, the governments of the world were definitely much stronger than the merchants of the world during this time. You had feudal governments. Basically, you had kingdoms and empires, and everyone was associated with some sort of monarch that had control of the land. The monarch owned the land, and everyone owed fealty up through that monarch. You owed your money, you owned your land, you owned your property up through that person. Now, there were some property rights, but all those property rights in general tended to be subordinate to a higher monarch. But that system provided a level of stability that did not exist previously. Yes, it would still do a lot of living season to season, but not everyone was involved in the agricultural trade, just a vast majority. So now you have, let's say, 90% of the population in agriculture instead of 100% of the population. So you have a small 5 to 10% wealthy class that controls the rest. Now, only a small portion of that class would actually be merchant class, and they wouldn't even be wealthy class. They'd start really be more of slightly better than peasantry, but not nearly as wealthy as what you might consider nobility or something along those lines. But we do have now a small investor class. And by here, investor class, I'm including basically the merchant class of these times in the 1500s. This merchant class would make investments. They would do trade. They would purchase goods in one location, transport them to another location, and attempt to make a profit. You could invest into those ventures. You could loan merchants money. Those merchants could take your money and provide you with an interest payment on that loan. There was still substantial risk here. But you have now an existing merchant class, and that merchant class is able to engage in commerce that's not solely derived seasonally. Now, some of these trades might occur over years and years and years. If you're doing long-term trade, then long-term loans can make sense, but your discount rates are going to be high. Now, why are your discount rates going to be high? What is it that would cause your discount rate in 1500 to be higher than the discount rate of 10% today? The reason is that what a discount rate is doing is it is discounting the future back to the present. Now, why would we do that? We do that because we would rather have money today than have money in the future. You know, if you were to be given the option, would you rather have $1 million today or $1 million 10 years from now? The rational answer for most people is they'd rather have $1 million today. Because if they have $1 million today, they have the opportunity to, one, spend the money today, and two, they have the opportunity to grow that money to a larger number than $1 million by the time 10 years comes around. So you have a dual opportunity. The piece that's often mentioned, that's not mentioned to those pieces, is there is a non-zero chance that 10 years from now, you will not be around to collect on that money. And this is where it becomes useful to think in terms of what things were like 500 years from now. What you had was you had shorter lives. There was a massive child mortality rate. There was a massive weakness to potential disease and to potential loss of life due to other causes, whether that be conflict and wars, local violence. All those things had been much higher in the past than they are today. Your chances of dying in any one year were substantially higher than they are today. So what this would require is you now have a small investor class, but they might be willing to make loans, but they're going to charge a high degree of interest for those loans based upon the fact that they have less certainty of the future than we do today. It's easier to project the future today than it is in the past because we live in a relatively more tranquil time. There's relatively less violence. There's relatively less potential for death in any one year. And the other piece is there's no real control of interest rates during this time. So you don't have central banks in the past that are controlling interest rates. They're forcing interest rates to be one thing. If you feel you need a 25% return on your investment, then you can demand a 25% return for lending money. And that's the other huge key here in the past. 500 years ago, it would have been normal and standard to invest and have that term investment to be solely associated with bonds. And by bonds, I mean lending in the form of loans versus equities. It would have been pure speculation to consider investing as in an equity portion alongside other investors in some sort of merchant venture. This idea has grown since then as been a profitable way of earning a return. But historically, you earned a return on your money through lending money in loans. So the question was not, are you going to make a loan or are you going to take an equity stake? It was always, I am going to take a loan. The question then becomes, what interest rate will I charge? And what you'll see is those interest rates historically would have needed to be higher than they are today, in large part because of some of these factors. So people lived shorter lives. People lived less safe and predictable lives. You had higher incidence of child mortality. You had higher incidence of disease, higher incidence of violence, all these sort of things. So when you're thinking about the future, and you're sitting there as a family, or you're sitting there as a company or a government, you're thinking about what the future will be like. Your confidence in your ability to take advantage of future money is lower than it would be today. So you're likely to demand a higher interest rate than you would today. The second piece is not only are you going to have a higher demand for interest rates, you're going to have a much lower supply that you have to compete against. Again, 500 years ago, you'd have a small or non-existent investor class. Your small investor class means that there's only a very limited number of people that you have to compete against. If the merchant wants money, they only have a certain number of people that they can ask that money from. They can go to certain nobles to request a loan. They can go to the king to request a loan. They can request a loan from other merchants. But all of that is a very small percentage of the population. 90% plus of the population is not saving money. They're not investing. They're not doing anything but trying to survive from one day to the next, from one season to the next, and from 1 year to the next. It's pure poverty, pure survival. So your percentage of the population that's capable of investing is small, and which means that the supply of money available for investments is small. That means when you have a relatively high demand and relatively low supply, the rational discount rate that an investor would choose is going to be high. Now, I can't speak for what that number would be. All I can say is it's rational that they would choose an interest rate that exceeds the current interest rates of, say, 10%. They might choose 20%, 25%, 30%. Now, all of it would be in relation to the currencies of the time. And that's where things are a little different. If you were to look at historic interest rates, they're going to be skewed in the sense that you are using non-fiat money. You're using gold, silver, which was extremely difficult to inflate away. So if you were to charge a 10% interest rate or a 15% interest rate, that's a 15% real interest rate. You don't have to worry about inflation, because if you're going to, loan out 100 gold coins and you charge a 15% interest rate, you're going to get back 115 gold coins. You don't have to worry that those gold coins are worth less than they were before, because it's the same gold coin. Versus today, if you were to loan out, US dollars for $100 and you have a 15% interest rate, well, you now have to take into account, what's the inflation rate? How much is the government going to devalue my currency in the time frame that this loan is taking place? That was not a major concern back then. Instead, it was simply real interest rates. So although you look historically, interest rates might not be as high as I claim, one of the caveats is that you didn't have the same risk of inflation as you do today. So let's accelerate from 1500 now to 1900. Things are changing. So in 1900, we're now only 100 years in the past. What has changed since that time? Well, modern medicine isn't fully here yet, so we don't necessarily have substantially longer lives, but we're on the way to doing so. Lives are lengthening, people are getting healthier, society is becoming more stable, more free. So the world is improving. But the key difference between 1500 and 1900 is two things. One, you now have the introduction and the possibility of making equity investments in addition to debt-based investments. Now, in 1900, it was still considered speculation to make equity investments instead of purely debt-based investments. But they did occur. It was just highly looked down upon as a source of earning a return. But the second key thing is that your investor class is growing. So you've grown from an investor class that might be 1% or less of the population, and now maybe you have 5 to 10% of the population which is able to save money and invest. Actually, that number is probably low. So depending upon if we're looking just at the United States, for instance, in 1900, now you have a substantial portion of the population that is able to earn money, potentially save money, and you have the growth of the banking industry, which banks existed before, but now banks can serve not just the wealthy, but they can serve the middle class, and the working class are able to put their money into savings and earn a return. And what's happening now is the banks are intermediating between those two groups. You now have savers and investors and entrepreneurs, and you have these three different groups, and the banks can now help connect those groups. So what has this done? Now, the demand for return is still high but it's getting lower. And that's because lives are starting to get longer and society is becoming more stable. So you don't need to have as high of a return, because now you can look further out in your life and plan more long term. It's easier to plan for the next 5, 10, or 20 years if you aren't hearing about all your friends dying every other year. So our lives are getting longer. That means the demand for discount rates is dropping. But in addition to that, you now have the supply of money increasing. And it's not just increasing from inflation, it's increasing because the wealth of the nation in the United States is growing. And this is true across the world, but we're using the United States for an example here because it's particularly relevant in 1900. The early 1900s in the United States were a huge boom of industrial activity. The country was growing. Wealth was starting to flow across the country. And what you're seeing is that the supply of money for investments is growing. And this is allowing and fueling a virtuous cycle for investments to be made and for more money to grow. Well, and that process has continued all the way through to today. But in the 1900s, you would have seen discount rates start to fall. So if we say discount rates were 25% in like the 1500s, I'm just making up numbers for illustration. maybe they've dropped to 20% or 15% by the time 1900 has come around. And this is partly because the demand has gone down, because you can see further out into the future, and partly because the supply of money has gone up. So there's more competition for loans. Now let's progress from the past to the present. So the present is what everyone's aware of. And so this is where we get into this idea that over the last 50 to 100 years, investments in the United States in equities have earned about a 10% return on average. This is where my 10% discount rate comes from that I use for investments today. But that belies a problem. What I've shown, or what I'm arguing in favor of, is this idea that discount rates have rationally been falling throughout our entire history. Now, there's certainly blips and ups and downs, of course, especially as inflation can change to be very high in some periods and very low in some periods. But across the aggregate, I believe it's a rational argument that discount rates have steadily fallen throughout our history if you were to graph over a 10,000 year period. So let's think about today. I'm saying I'm choosing a 10% discount rate based upon returns that have occurred over the last 50 to 100 years. Well, there's a fallacy here. The fallacy is I'm choosing a return that may no longer be reasonably expected for the future, because if the last 50 years have given a 10% return, why shouldn't it be true that the next 50 years should probably offer a less than 10% return, if my assertions are true? Because what you'll see today is there's another huge difference between 1900 and 2020. Sitting here in 2020, the lives of not just Americans, but worldwide have drastically increased. You're having people live not to 40 or 50 years old, but people are living to 80, 90, or 100 years old. The expected lifespan from birth is higher than it's ever been in the history of the world today. Which means that when you're sitting there at 20 years old, you have a job, you're starting a family, and you're thinking about the future. You don't have to think simply about 5, 10, 15 years in the future. You're not worried about just having as many kids as you need to today because you never know how long you have. Although that's still true, you can start to plan for the future. Sitting at 20 years old, your expected lifespan might be to live another 55 to 60 years on average. What this has done is it means the average person at 20 and 25 years now has a 60-year future that they can plan for, which means that they don't need to invest for 10 years and harvest gains for 10 years. It means they can invest for 50 years and harvest gains for 20 years, or they can invest for 40 years and harvest gains for 20 years. This means their discount rate is lower, or it should rationally be lower than it would have been if they were born 100 years before today. And this is because their demand for returns is lower. If you need a certain amount of money, there's 2 ways to get it. You can earn a higher return, or 3 ways. You can earn a higher return per year, you can invest more years, or you can save more money. Now, often, although saving more money tends to be the most effective one that you have control over, the other 2 tend to be more the product of society, earning higher returns and investing for longer. Well, we now have the ability to invest for longer than ever because our lives are longer than ever. So, if the other avenue that could change, if you hold everything else equal, is that our average returns should plausibly drop over time, because we can now invest for a longer period while saving the amount of more money. Now, if we earn the same amount of returns, it's going to mean that we're going to become wealthier and wealthier, and that is what you've seen in the past. We're still earning very high returns. Some double-digit returns, whether they're 10%, 11%, 12% or more, are very high returns that offer you the ability to get very wealthy if you can invest over a 50-year period. So, I've talked about then how in the present, our demand for returns is plausibly and rationally lower than it would have been 50 years ago. Because our lives are longer, violence is lower, Our country and our world is more stable. But the other side of the coin is again supply. And what you've seen is over the last 50 to 100 years, worldwide poverty, and here I'm going to expand from just the United States to the entire world because I think it's very relevant. Worldwide poverty has plummeted. You've gone from over half the world living in poverty to about 10, or wait, let me get the right number here. I want to use the right number. This is really good news. Yeah, so here I got the right numbers. Here's from ourworldanddata.org. So if you go back to 1820, 84% of the world was living in extreme poverty, which is considered living in less than $1 per day. And you had 94% of the world living in poverty, which is less than $2 per day. If you fast forward and you take that number down to 1990, you'd gone from 84% living in extreme poverty to 24% of the world. And that was in 1990. Well, if you accelerate it all the way forward, in 2015, the World Bank data suggests that less than 10% of the world today lives in extreme poverty. So that means you have an additional 75% of human society that has moved out of poverty and into a class of people that is able to save money and plan for the future. That is a huge increase in the supply of the investor class. Now, we can debate the investor class all we want. I'm not talking simply about the people that manage investments for a living. I'm talking about the people who are able to save money. Because what banks do is they intermediate between savers and investors. So investors are able to leverage money that's put into a bank account by a saver. So even if you're only saving $10 a day even if you're only saving $10 a week or $100 a week or $1,000 a week, all of those monies from those savers are able to be funneled into investments, which make all of those savers part of the investor class. So what you've seen is moving forward to 2020, moving forward to today, not only has demand decreased, but the supply of money available for investments are at all-time highs because the investor class is huge. Almost the entire United States is now able to fall into the investor class. Most of the world now falls into the investor class. So you have now a majority of the world able to save money in some form or another and think about the future. Now, on a rational basis, when you balance out the supply and demand and you consider the fact that the number of investments available at any one time is finite. Now, it's certainly increasing all the time, but it is finite and limited, and there's a limit on just the process of making those investments. It takes time and money to connect those people. Then there's a rational basis for joint drivers of discount rates to drop. So if we say that over the last 50 years, returns on equities have been 10%, it would also be rational to say that we should expect that they'll be lower over the next 50 years, not because the economy necessarily is producing less wealth, but because that wealth has to be shared amongst more investors, which means that those investors are going to bid up the price of assets until discount rates are lower than they were in the past. This is a huge driver for why you see worldwide interest rates today, government interest rates at 0% or negative. It's a huge understated reason. One of the big places that it's blamed on is global central banks. And I do think global central banks are manipulating interest rates lower than they probably would be in a market rate. I think market interest rates are higher than 0% today if central banks stopped controlling the interest rates. But I don't think that they're as high as 10%. And the reason for this is very clear. You have massive supply of money from worldwide participants seeking a return. And the demanded return is lower than ever because they're able to see into the future longer than they ever have in the past. So why do I still use 10%? So I think probably a reasonable number to use for a discount rate for the expected equity return in the United States for the next 50 years is somewhere in the range of 6, 7, or 8%. I think that's a reasonable number, and this would justify higher prices of stocks. So stock prices and stock valuations should justifiably trade at a higher price today than they did 50 years ago because the supply of money going into stocks is much higher. Now, this falls into that category of, this permanently high plateau or whatever, but I think plateau is a problem because it implies that this is flat. What I'm saying is the level of valuations that investors should be willing to accept should steadily increase over time. Now, these time frames are going to be more than a generation, so it might not necessarily be noticeable from year to year. I'm not saying that valuations should rise every year. I'm saying that over the course of decades and centuries, we should steadily accept higher and higher valuations in stocks and bonds, which adjust for the fact that the investor class is growing and future returns should justifiably be lower for capital because we can now live longer lives and plan more for the future. So if I think 8% is a reasonable return for US-based investments over the next 50 years, I'm choosing to stick with the 10% discount rate for two reasons. One, to challenge myself. I think it's important for me to choose a discount rate that exceeds the future returns of the broad index, because that 2% gap is justification for me managing my own investments. If I think that the stock market's going to return 6 to 8%, but I can earn 10% managing it myself, then that justifies me spending time managing my own stock portfolio. Meanwhile, if I think that I could only match the S&P 500, then I can't seem to justify the extra time and expense that I put into managing my stocks and choosing specific investments. The second piece is it shows a clear limit of my opportunity cost. If I set my discount rate at 10%, I'm saying that my opportunity cost is 10%. That means I'm not willing to consider any new investments below a 10% potential rate of return because all the investments I have found previously have also exceeded that rate of return. So as long as I'm still able to find investments that meet a 10% discount rate, it would be foolish for me to lower the discount rate. Now, if I search for investments for 5 straight years and I'm not able to find a single company that meets my 10% discount rate, then maybe it's prudent just to begin considering lowering that discount rate. But I continue to find plenty of investments that meet my discount rate. They just happen to be a relative minority of the market. I don't think most of the market would meet it. At least 50% of the market won't meet my 10% discount rate. And I'd argue, at least at today's prices, over 80% of the market wouldn't meet my 10% discount rate. But I don't need 80% of the market. I just need enough stocks to fill my portfolio. So you're talking 5, 10, 15, 20 stocks. Well, over thousands of stocks being available, that's not necessarily something difficult to do. So it can make rational sense to have a discount rate that's higher than the expected return of the market if you're able to continue to find stocks that meet it as a hurdle. So basically, my discount rate functions as a rational hurdle on how much return I expect for my portfolio. And it limits me spending time on companies that don't meet the same level of return that the rest of my portfolio is already set up to earn. Why should I put new money into investments that are going to earn lower returns when I always have the option of simply buying more of the stocks that I currently own? So, let's talk about the future now. I think I've made a strong case that over the last 10,000 years up to the present, we've seen a steadily decreasing discount rate demand and steadily increasing supply of investors, such that the market discount rate is lower and lower over time. Now, as we think to the future, let's first ground the present. Interest rates in the United States and across the world are approximately 0% as set by the central banks of the world. And you could argue market rates would be slightly higher, 1, 2, 3, 4%, something in that range. But let's think about the future. When we think about the future, will these trends continue? Will I have to at some point lower my discount rate from 10% to a lower number? And this is a particularly relevant question. You've seen famous investors do these adjustments over time. Warren Buffett used to demand a discount rate of 15% in his investments when he was investing 40 or 50 years ago. This was prudent because of his opportunity set was much more attractive, and it was reasonable to set a hurdle rate at 15%. Versus today, he's talked about how a much more reasonable number would be something on the lines of 10%. So, in the future, will I have to operate with a discount rate of 5% within the next 50 years? Could I, as an investor, rationally see 5% not only as a hurdle rate on my investments, but also as the reasonable return that you might receive on stock investments in broad-based indices? And I think the answer is yes. Now, I don't know if 5% is the right number. I'm trying to directionally get the number right. I'm not trying to predict what the number will be. But it's more being open to the idea that my discount rate, as my life progresses, should go down. Why is that? And I think it's because these trends are going to continue. One of the big trends I've talked about is our lives getting longer. Well, what if there's an opportunity for massively longer life for those living and alive today? There is a subset of the medical community that is focused on research around various aging-based diseases, stuff like Alzheimer's, dementia. Basically, as we get older, we start taking on deterioration in our health, deterioration in our bodies, deterioration in our mind. And all of these effects start to play out on us as people. Well, as research has been around and focused on attacking certain things, so a lot of research has been on stuff like cancer, we've found ways to extend people's life by focusing on little bits and pieces of the things that kill us. So if cancer kills millions of people every year, each time you cure one form of cancer, then you're extending the life of those people. And it means that something else will eventually be the killer for those people. Because what tends to happen is we talk about people dying of old age. But that's not actually true. People don't die because they reach a certain age. It's not like every time someone turns 100 on their 100th birthday, they just keel over and die. That's not how life works. What happens is their cells break down, their organs break down, their brains break down, and the pieces of them no longer function at a level that can support life. So, what medicine has been doing is that we've been individually attacking all the causes of death that we have, and we get better and better over time at fixing them. So the question is, and especially in the last decade, you start to have the proposal is, will it be possible to massively extend life? So currently, around the reasonable limit that people are living to is around the age of 120. So it's rare to live that long, but that's about the longest that people are able to live so far. But there's been proposals that it's possible, if medicine continues progressing at the rate that it is, that the first person that will live to the age of 1,000 may have already been born. This has been proposed as a thought experiment that basically, for instance, when you cure a form of cancer, let's say you get breast cancer. Well, it used to be a pure death sentence, and now we have lots of treatments for breast cancer. So now someone with breast cancer, depending upon the stage, might have a life expectancy of an additional 5 years or 10 years or longer because there are methods we can use to treat it. Well, the idea behind this process is over the next 10 years, maybe we're able to come up with enough medicine to extend the average life of humanity by 3 years. And during the 10 years after that, maybe we can extend the average life of humanity another 5 years. And what this adds up to is maybe over the next 50 years, we're able to extend the average lifespan of a human 40 years. And in those 40 years, you're able to extend the lifespan of a human an additional 35 years. And basically in those 35 years, it extends the lifespan another 30 years. And this continues until the research in the medicine is progressing fast enough that you start to have the implication that lifespans could extend to an unreasonably long period of time, something on the range of hundreds and thousands of years old, so that the idea of old age death ceases to exist as a main idea within our society. Now, for those who haven't been introduced to the concept before, this might sound kind of out there, but there's a small subset of various communities in the medicine that are focused on finding ways to extend life and attacking all of the individual causes of death. And basically the thought process is if you prevent all the major processes that lead to death, and you can find ways to reverse those aging causes, then you can extend life substantially. So what happens? I'm not here to discuss whether that's going to occur. What I want to say is, let's make the assumption that it does occur. Let's make the assumption that it occurs to a very small degree. Not that we live to 1,000 years, but what if we could live to 150? Or what if we could live to 200? And that became normal. What if, when you're 25 years old, you have a job, just got married, you look forward into your future life, and instead of seeing a life that goes from 25 and then you end up dying somewhere in the range of 80, 75 or 85, you look out and you say, I don't have 50 years to live. I have 125 years to live. I might live to 150. How would that change your discount rate? Would you be willing to accept a lower return each year because now you have more years to live? And rationally, I think you would. So as the process continues, where it becomes more and more possible for people to see themselves living longer, investors are going to rationally accept lower rates of return, which means they're going to rationally accept higher valuations on stocks. And if there ever became the possibility that people could live forever, or 1,000 years, which is functionally forever in terms of our modern context, then the discount rate that investors would demand on capital and on savings would approach zero. I don't think it would reach zero. I think you would still argue for a positive rate of return. But basically what it would do is it would start to reach the point that if you knew you were going to live for an additional 100 years or 500 years, you might not see a huge difference between $1 million today and $1 million 10 years from now, because you're going to be around for another 100 years. And when that mindset change occurs, you're going to start to see discount rates drop. Now, again, I'm not predicting that this will occur. You can do your own research on the fight against aging if it's interesting to you. It's interesting to me, but feel free to research it yourself. The argument is simply that this is a possibility. We've seen this occur from the past to the present, and if it occurs more in the future, you're going to see a mindset change, which I think will lead to lower discount rates. So, the key point here, before I move on to supply again, is not whether people actually live longer. It doesn't matter if someone who's 50 today lives to a 200 if they only expect to live to 75. What matters is the mindset change. The change in discount rates will only occur once the person that's currently 50 expects to live to 150. And when that expectation changes, you'll see the discount rates change as a secondary element. It is a dependent variable on the expectations of investors, which will determine what they're willing to accept in terms of return on their investment. So that talks about the demand piece. What about supply? Well, you've seen this trend over the last 10,000 years of increasing prosperity, of a growing investor class, and I believe this trend is only going to continue. You will eventually reach the point where poverty will be eliminated worldwide, and every person living on the earth will be capable of being a saver that contributes money that will expect a return on their investment, because they are able to supply a surplus into the banking industry, which can then take that surplus, provide it to the investors that are making the financial decisions, and make investments on their behalf. And as this investor class grows from a large investor class today, where you talk about a large middle class, but it grows to encompass the entire population of humanity, you're going to see a massive supply of capital into the market. So your supply is going to grow, which is going to force discount rates down. And if my assertion earlier about longer lives also becomes true, then the demand for return will also decrease, leading to lower discount rates. And so the crux of this assertion is that future discount rates are going to trend towards zero, such that if we look out into the infinite future, the rational point is that discount rates should be approximately zero 5,000 years from now, if these things come true. And so the returns on capital will decrease over time as long as these factors continue to persist. Now, will they? I don't know. I can't predict the future. What I can say is how these different elements are working together. And if you think from first principles and you understand the drivers of discount rates and the drivers of the changes in how investor psychology works and what investors are looking for in returns, and you combine that with the supply of money that's entering the system from a wealthier and wealthier nations, wealthier and wealthier citizens, then you'll understand why discount rates can rationally approach zero over time. I hope that this episode has illuminated in you some greater understanding of why it might be rational that valuations in the stock market should increase over time, and why looking simply at historical performances or looking at historical valuations about what's normal can cause you to make mistakes, because it might cause you to underestimate what's coming in the future. Now, in today's podcast, I didn't talk about what would happen in the global economy or inventions or new technologies that could drive growth in the economy, because that's not what's relevant. That's the source of where the returns may come from. We're not talking today about the source of the returns. We're simply talking about the supply and demand of investors around their discount rates. And there's many different ways this could go. If you had a rise in the investor class without longer lives, you're going to have a high demand for returns, but a low capability of earning that. And that could result in a lot of dissatisfaction. A lot of people want return, but they're unable to receive it. And that basically describes a lot of today. The demand for return is still high because our lives aren't infinite, but the number of investors continue to grow. And so there's more capital than there are good investments. That's basically today's situation. You could go the other way too, basically where the longer life scenario occurs, but the investor class actually decreases. There's ways this could occur. Basically, this would be the scenario where a huge wealthy elite is able to rise that puts down the rest of the world and reverses the rise out of poverty so that it's all monopolized by a few elites. And so they're able to earn high returns on capital, and they prevent others from receiving those returns. I don't think that's where it will go, but that is a possible future. So there's different ways it can go, but I think the most likely scenario is you head towards that discount rate of 0. Anyway, I admit for this to be a half-hour episode, and we're basically at an hour. I hope that this has been helpful to you. I'm unsure if anyone actually was still listening to me at this point, but this is something I think about in the sense that I use a 10% discount rate today, but I also know it will not be rational to do so at all points in the future. In fact, I would be pleasantly surprised if I'm able to continue earning double-digit returns throughout my entire lifetime, because I think the standard for valuation will grow such that, just like in the past, it used to be possible in the United States to buy net nets, and they're basically impossible today. Today, it's possible in the United States to buy companies at single-digit PE ratios. It's rare, but possible. It's possible in the future that it will be rare to find companies trading below a PE of 25. And so I think that's something that is worth thinking about, and I think it's worth, until you think about this, you may not really understand what goes into discount rates. And anyway, I hope this has been helpful to you. The full show notes for this episode, including my outline for today's podcast, are available at DIYinvesting.org/episode 92. Please remember this is a listener-supported podcast. If you've gained value from today's content, please consider supporting the show financially as a patron. You can become a patron at DIYinvesting.org/PATRON. If you can't support the show financially, consider sharing the show with a friend. Just tell a friend about the show, someone that you talk to about investing, and let them know that you find my content interesting. I really appreciate it. Thank you for listening, and until next time, stop paying fees, start building wealth.
Thank you for listening to the DIY Investing Podcast. Please visit our website and subscribe to our email list at DIYinvesting.org for guides, videos, and resources to help make you a better investor.
The DIY Investing Podcast is presented for general informational and entertainment purposes only. I have not considered your specific situation or risk profile, and I have not provided investment advice. The information presented on the DIY Investing Podcast should not be construed as investment advice. The views and opinions expressed on the DIY Investing Podcast are those of the participants and do not necessarily reflect those of the show's host or sponsors. DIY Investing, its producers, sponsors, and host, Trey Henniger, shall not be liable for losses resulting from investment decisions based upon information or viewpoints presented on the DIY Investing Podcast.